California's housing markets affect the state's economy in various ways. In just a moment, my colleague Justin Garosi will discuss some historical trends in home prices throughout California. And afterward, I'll discuss a couple of reasons why our office thinks home prices have increased so quickly in recent months.
To put the recent increases in housing prices into context, we think it would be useful to review how they've changed over the last 20 years or so. We're going to use the Federal Housing Finance Agency's index, which takes repeat sales of houses that have sold more than once. Now, this index only covers mortgages that can be picked up by Fannie Mae or Freddie Mac, so it excludes the most expensive houses and it excludes subprime loans. Everything else is in there. So we start in 1991. That 100 on the vertical axis does not mean $100,000. It just means whatever prices were at the beginning of 1991. Okay, prices declined steadily from 1991 to about 1996. This was in part a function of the weak economy. The state badly lagged the rest of the country in the early 90s as we lost a lot of defense contracts. In the late 90s, we had the dot-com boom and the housing market picked up. So far, the housing market's basically following the economy. But then, after the dot-com boom turned into a bust, housing prices just kept going up even while the economy struggled. This, of course, turned into the housing bubble where prices rose way out of line with rents and with people's incomes. At the peak, housing prices were nearly 3 times as high as they had been in 1999 during the dot-com boom. And then the bust was just as dramatic as the boom. At the national level, this is what caused a financial collapse that nearly led to a second Great Depression. At the state level, our budget was in worse shape than almost any other state. Prices went back up a little bit in response to temporary federal housing subsidies in 2009, but after these expired, they continued to drop. Since 2011, prices have been going back up. By the second quarter of this year, they were still only about to where they were in 2003, but the trajectory looks like it did during the bubble. We'll explain what we think this means a little later. It's important to remember that the state is not a single housing market. Here we look at 4 different areas. This is LA County. It has more than a quarter of the state's people, and its graph looks a lot like the state average. Here in red, we have Riverside and San Bernardino counties combined. They moved almost in lockstep with LA County until the crash, when they fell a lot further. In green, this is San Jose and Santa Clara County and the biggest concentration of high tech in the state. Prices went way up during the dot-com boom. They didn't fall as far as in other areas during the bust, and they're almost back to their peak. Here's Stockton and San Joaquin County in purple. It fell even further during the bust than Riverside did. In both the north and the south of the state, the cheaper inland areas were hit harder than the more expensive coastal areas.
After struggling through much of 2011, home prices began to tick up in early 2012, and since then have increased about 25% statewide. And unlike past home price recoveries, these improvements have been widespread. In fact, in each of the state's largest metropolitan regions, home prices have increased at a minimum of 10%. And rising home prices come as welcome news to homeowners, improving their equity stake in their home. And since early 2012, the share of homeowners that are underwater on their mortgages has fallen from 30% to just 15% today. The strong price increases we've seen over the last 18 months seem a little out of step with growth in the state's economy, which has been moderate at best. In a normally functioning housing market, rising prices tend to compel sellers to sell their homes and also for developers to begin construction on additional housing. At the same time, these rising prices generally push some would-be homeowners out of the buyer's market as maybe down payments become unaffordable. And the net effect of sort of expanding supply and diminishing demand usually causes increases to slow down or stop altogether, and in some cases reverse. But contrary to what we would normally expect, the supply of homes over the last 18 months has actually contracted while prices have increased. In fact, as you can see in this chart, the supply of homes is about half of what it was just a year ago. This is not what we would expect given the strength of price increases we've seen. And this leads our office to view recent price increases more as a function of limited or constrained supply than strength in the state's underlying economy. There are a few factors we've identified that might be constraining the supply of available housing, and we go into them in detail in our report, The Fiscal Outlook. The supply of for-sale homes has clearly been constrained over the last year and a half. A few data points that we've received in just the last couple months suggest that the supply might be expanding. In particular, the inventory of for-sale homes has increased in August and again in September for the first time in more than a year. And also, mortgage interest rates have ticked up slightly since May, causing borrowing costs for would-be buyers to increase somewhat. We think this is probably diminishing buyers' demand for new housing. As we would expect, as the supply of homes expands somewhat and the demand for new homes also weakens, home price appreciation over the summer months began to decelerate. While it was still increasing, it wasn't increasing quite as quickly as it was during the beginning of this year. We view this as the housing market beginning to normalize somewhat, which we think will continue into 2014. Taking into account the most recent indicators in the state's housing market, we expect housing prices statewide to increase by about 7% in 2014. And as the state's economy continues to improve, home construction and construction employment also will improve. As shown in the figure, our office expects that about 120,000 single and multifamily permits will be issued for new construction in 2014. This is up by about 35% from this year. In the out years of the forecast, single and multifamily construction should normalize at about 150,000 units per year. Interestingly, multifamily construction should outpace single-family construction in future years, and this is a reversal of current trends, one that our office is going to be paying particular attention to as the state's housing markets continue to recover.